Can you introduce us to these changes?
I sure will. All right, so under the new law, in order to qualify for both the non-refundable CTC and the refundable ACTC, the qualifying child now must have a valid Social Security number issued before the due date of the tax return, and that includes extensions. This is a big change. The child tax credit is worth up to $2,000 per qualifying child, and the age requirement did remain the same. The child must be under 17 at the end of the year in order to claim the credit. Now, the refundable portion of the credit has also gone up, and that's gone up to $1,400 per qualified child. That amount will also be adjusted for inflation after tax year 2018. Now, the earned income minimum in order to qualify for the refundable ACTC with only one or two children was $3,000 in the past years, but now it's been lowered to $2,500. Also in past years, a taxpayer claiming the CTC ACTC must have been able to claim an exemption for each child on their tax return. Now, even though the dependency exemption is now zero until after tax year 2025, the taxpayer must still meet the dependency rules in order to claim a qualifying child for CTC ACTC. So you still need to do your research and your due diligence. Now, as in the past, the child must be a U.S. citizen or U.S. resident. Therefore, any children that might be residing in Mexico or Canada who weren't U.S. citizens won't qualify for this credit, will not qualify. There is also another significant change I wanted to share with you, and that's affecting your clients with higher income. So we're going to take a look at a chart, and you'll begin to understand why here. So first, let's start with a little history lesson. The CTC first appeared on the scene in 1998 as a small non-refundable credit of $400 for each qualifying child under 17. And as we all know, over the last 20 years, that credit has gradually changed. And through the past filing season, the child tax credit was worth up to $1,000 per qualifying child and was refundable for taxpayers with earned income of at least $3,000. And also, it phased out for taxpayers with an AGI above $75,000 for single taxpayers or $110,000 for joint filers. So if you're looking at that chart, you'll see what's new. As you can see in this chart, the phase out in claiming one qualifying child for the child tax credit has increased to $200,000 for a single filer and $400 for joint filers. The phase outs are greater if multiple children are claimed for CTC or if the ODC is also claimed. Now, because of rounding rules, a $2,000 CTC or ACTC is reduced to zero if the income is above the $239,001 for a single filer or $439,001 for someone who's married filing joint. That obviously represents a huge change to the number of taxpayers that may be qualified to take the credit. All right, we need to explore some of the rest of the requirements for your client to be qualified to receive the full credit. Now, some of the requirements haven't changed, but we want to just review them very quickly. The child must be related to your client, such as a son, a daughter, nephew, etc. And the child must be under the age of 17, that means age 16 or younger, at the end of the tax year. The child must not have provided more than half of their own support, and the child must be a U.S. citizen, U.S. national, or a U.S. resident alien. The child must have lived with the client for more than half of the tax year. But don't forget to explore some possible exceptions during your interview that might apply if that child happened to be away at a school. Now, we do also want to make sure you understand that if a child was born and died during the year, you do not need a Social Security number. But if that's not the case, they do need the Social Security number. In fact, the child must have a valid for employment Social Security number. Now, interestingly enough, the taxpayer, whether it's primary or spouse, may have an ITIN. So the taxpayer can have an ITIN, but the child must have a Social Security number that is valid for employment. So what does a valid for employment Social Security card look like? Basically, it's either going to be a basic Social Security card that has no additional markings, or the card is going to state valid for work with DHS authorization. Now, if that Social Security card states not valid for employment on the child's card, then your client will not be able to claim that child for CTC or ACTC. Okay, we've given you a good bit of information. I think, Karen, this is a good time for a polling question.
You're absolutely correct, Anna. Yeah, so we've got some new rules and we've got the same existing rules. So this is part of the new rules. All right, you guys, here's the question. Will the taxpayer possibly qualify for CTC, ACTC if A, the parent has a Social Security number and the child also has a Social Security number, B, the parent has a Social Security number and the child has an ITIN, C, the parent has an ITIN and the child has a Social Security number, D, both A and C, or E, both A and B. Again, if your polling style feature didn't pop up, respond using the Ask Questions feature, and you only need to put in A, B, C, D, or E, whichever one you think is the right answer. Okay, and I'm going to go ahead and read it again and go through the selections again. So, will the taxpayer possibly qualify for CTC, ACTC, if A, the parent has a Social Security number and the child has a Social Security number, B, the parent has a Social Security number and the child has an ITIN, C, the parent has an ITIN and the child has a Social Security number, D, both A and C, or E, both A and B. I'll give you a few more seconds to respond. Anna just went over it. Hopefully we have 100% accuracy because everybody's been paying attention and there's been no problems or issues with technology. Okay, let's close the polling and let's see what the correct answer is and how many got it right. Okay, so the correct answer is D. Both A and C are correct. Because under the new law, a child with an ITIN will not qualify the taxpayer for child tax credit, additional child tax credit, even if the parent has a valid Social Security number. And let's see how many of you got that right. 80%, way to go. I'm happy with that. That is terrific. So we are comfortable with child tax credit, additional child tax credit. Let's find out about the new credit for other dependents. And Karen Bermer is going to tell us all about it. Karen, go ahead.
Great. Thank you, Karen. TCJA added a $500 credit for qualifying dependents, and this is the credit for other dependents. It is non-refundable. The credit is for dependents that don't meet the definition of qualifying child for the child tax credit. So, if a dependent does not qualify for the taxpayer for the child tax credit or the additional child tax credit, that dependent might qualify the taxpayer for the credit for other dependents. And here are some examples of dependents that might allow the taxpayer to take this credit. It could be the taxpayer's older qualifying children, those who are age 17 or older at the end of the year. It could be other qualifying relatives who are 17 and older. This could be someone such as an aunt or an uncle. The dependent might be a parent who depends on care from that taxpayer. And this credit also applies to qualifying children with an ITIN or an ATIN. And in is an adoption taxpayer ID number. I did want to mention I saw a question in there about an ITIN. An ITIN always starts with the number 9, and you can find more information about ITINs on irs.gov. Unlike the child tax credit, additional child tax credit that we were just talking about in the polling question, the credit for other dependents, for that one, the dependent and the taxpayer, either the primary taxpayer or the spouse, can have an ITIN. So an SSN is not a requirement for the credit for other dependents. However, they do need to have the ATIN or ITIN, and whether it's the ATIN or the ITIN, they need to be issued by the due date of the return, including extensions. Now, the ODC can only be claimed for dependents who are U.S. citizens or U.S. residents. So that means that the dependents residing in Mexico or Canada can't be claimed for the ODC if they are not U.S. citizens. And that rule is similar to the rule for child tax credit, additional child tax credit. Okay, this is fast, but it's time for another polling question. And this one is on the credit for other dependents. And Karen, will you do the honors of the polling question?
Yes, it's a good thing that we did a little practice because I was totally shocked when this polling question came up the first time. I'm like, what? Okay, you guys, so here's our second polling question already. The taxpayer may qualify for the credit for other dependents if A, the taxpayer has a Social Security number and the dependent has a Social Security number. The taxpayer has an B, the taxpayer has an I-10 and the dependent has an I-10. C, the taxpayer has an I-10 and the dependent has a Social Security number. D, the taxpayer has a Social Security number and the dependent has an I-10, or E, all of the above. And again, if you don't get the polling style feature, use the Ask Question feature to submit your answer and just send in A, B, C, D, or E. And if you do get the polling feature, just mark the radio button next to your answer. Okay, and let me read that one more time. If the taxpayer can't qualify for the child tax credit or additional child tax credit, they may qualify for the credit for other dependents if A, the taxpayer has a Social Security number and the dependent has a Social Security number. B, the taxpayer has an I-10 and the dependent has an I-10. C, the taxpayer has an I-10 and the dependent has a Social Security number. D, the taxpayer has a Social Security number and the dependent has an I-10, or E, all of the above. The taxpayer may qualify for the ODC if, is it A, B, C, D, or E? I'm counting to myself down to 3. Okay, let's stop the polling. Let's close the polling and let's check out what the correct answer is on the next slide. And it is E. Hopefully everybody got that right. All scenarios are possible if the taxpayer was unable to claim the dependent under the child tax credit and additional child tax credit rules. In this case, the dependent is a qualifying person for the ODC only if the dependent is not qualifying under CTC or ACTC. The taxpayer cannot claim both. All right, and let's see how many of you guys got that right. 90%. Awesome. Okay, Karen, back to you.
All right. Thank you, Karen. So let's talk about head of household qualifications. As a tax preparer, your due diligence requirements were expanded by TCJA. So what's new is that Form 8867, which is the Paid Preparer's Due Diligence Checklist, now has a column for head of household. And we're going to show you that new Form 8867 in a few minutes. So the law around the head of household rules didn't change, so that's good, right? But since the head of household filing status is a new due diligence requirement, let's brush up on some of the general rules that can qualify your client for head of household. So to claim head of household, your client must pass 3 tests. They need to be unmarried or considered unmarried for the tax year, and have a qualifying child or dependent, and pay more than half of the household expenses. So how will this due diligence requirement change what you need to do? Let's say you're completing a return and the taxpayer appears to be qualified to claim head of household. You'll need to complete the head of household column on Form 8867, Paid Preparer's Due Diligence Checklist. And you'll need to answer the related questions, and what you're doing there is you're confirming that you practice due diligence in determining your client's ability to claim the head of household filing status. We have two tools you can use. The first one is, this will help you with determining if your client is eligible to claim head of household. It's Form 13614-C, and I'll repeat that number a few times. The title of that form is Intake, Interview, and Quality Review Sheet. You can use this form to review the questions that are asked in the section on marital status. And again, that's Form 13614-C. It's available on irs.gov, and it can be downloaded and printed for free. It's available in a lot of different languages, more than our normal selection of languages. It's available in English, but also Spanish, Korean, Chinese, Vietnamese, Portuguese, Polish, and other languages too. Again, that's Form 13614-C. And I wanted to mention one other tool that's available to you. If you go to irs.gov and search for Interactive Tax Assistant, and then what is my filing status, that could be a helpful tool. So Interactive Tax Assistant, what is my filing status? Okay, so there's 4 steps to meet the due diligence requirement. First, you want to apply the knowledge requirement. You need to know the applicable tax law for all the credits, including the new credit for other dependents, as well as head of household filing status. And second, you need to compute the credit.
Your client had a child that was born and died in the same year. They would put the word died on the Schedule EIC if they were claiming EIC, or child tax credit or ACTC, and they would include the birth certificate or medical records showing that it was a live birth, and the death certificate showing that they died. So they would include those two and write the word died on the tax return as well as the forms, and they would be entitled to the credit. They would be entitled to child tax credit, additional child tax credit, earned income tax credit, whatever would qualify your client based on their